Episode 2. Last time, we stood inside the chaos, the colored jackets, the hand signals, the scrum of human beings discovering the price of wheat and corn and oil, together, loudly, in real time. But we left with a question. The best traders in that pit weren't just lucky. They had something. What was it exactly? Beyond the pit, a different breed of trader was operating, the macro traders. Men like Paul Tudor Jones, who didn't stand in a pit. They sat at a desk, watched the world, and made enormous bets on where it was going. Jones famously predicted the 1987 crash almost to the day. Not from a model, from reading. Newspapers, history, the behavior of markets during previous manias. His edge was the same as the pit trader's edge, just applied at a higher altitude. Pattern recognition, built from immersion. Impossible to fully articulate and, crucially, impossible to transfer. Here is the fundamental problem with human judgment as a trading strategy. It lives in one person's head. You cannot write it down. You cannot teach it in 6 weeks. You cannot hire 200 people who all have it. The great discretionary traders were like master craftsmen, extraordinary, irreplaceable, and completely unable to scale. A trading firm built on human judgment is only as good as its best humans on their best days. And humans, as October 1987 was about to demonstrate, have very bad days. October 19th, 1987, Black Monday. The Dow Jones Industrial Average fell 22.6% in a single day. Not over a week, not over a month. One day. In dollar terms, the United States stock market lost $500 billion before the closing bell. The pit traders were overwhelmed. The macro traders mostly saw it coming but couldn't stop it. And the strange thing, the thing that nobody could fully explain at the time, was why it happened so fast. The answer involved something called portfolio insurance, and it pointed toward a future that nobody in a colored jacket had prepared for. Portfolio insurance was supposed to be a safety net. The idea was simple. As markets fall, automatically sell futures to hedge your exposure. Protect yourself on the way down. Thousands of institutional investors had adopted it simultaneously. And when the market began to fall on that Monday morning, they all did the same thing at the same time. Their selling pushed prices lower. Lower prices triggered more selling. More selling pushed prices lower still. A feedback loop, automatic, unstoppable. No human being decided to cause a crash. It emerged from the interaction of thousands of individually rational rules. For the first time, markets had behaved like a system, and no human intuition had a model for that. After 1987, something shifted. Not immediately, not everywhere, but in certain rooms, certain offices in universities and research labs, people who had never worked on a trading floor began to ask a different kind of question. Not what do I think the market will do, but what does the data say? They were mathematicians, physicists, people who had spent their careers finding hidden structure in apparently random systems. And they looked at financial markets the way they had looked at turbulence, at statistical mechanics, at the behavior of magnetic materials, as a problem to be solved. One of them had been asking that question since 1963. His name was Benoit Mandelbrot, and the answer he had found, decades earlier largely ignored, was about to become the most important idea in finance. Next time, the mathematics of chaos.